Have you ever watched a card go absolutely nowhere? You did the work, you read the supply structure right, you understood why the card was undervalued. The gem rate, the pop, the player's trajectory, the set standing relative to everything else in the same tier. You told everyone who would listen. Discord, group chats, your collecting friends who'd been in the hobby long enough to take you seriously. You were sounding like a broken record. Weeks turned into a month turned into 2 months turned into, in some cases, years. But the market just didn't care. The price just didn't move. And then one morning, you wake up and someone's paid 3 times what you paid for the exact same card. Then you see another sale, then another. Your Discord lights up. People suddenly asking where to find these cards and whether any are still available. People on Facebook Marketplace trying to post sales for these. Your thesis, the one you'd been articulating for months to politely nodding faces, has become consensus overnight. That's the gap. The one between being right and the market agreeing with you. That's what this episode is about. This concept is called financial inertia, and it's the single most practical framework I know for understanding why card markets move when they do and how they do. Not why a specific card might go up or down. I talk about that in individual deep dives, but why markets as a whole seem frozen until they're not. Why prices hold when they should break. Why rallies start without warning and corrections seem to happen the day after you bought in. Once you understand the forces that hold markets still and the forces that break them loose, you'll see the card market differently. Let's get into it. Before I explain what creates inertia in a market, I have to explain who creates it. There's a study, and I know this sounds like I'm about to talk about something completely unrelated to cards, but stay with me. This study shows 78% of Americans believe they are better than average drivers. Now, mathematically, that's impossible. You can't have 78% of people sitting above the 50th percentile. But that's the number. That's how we assess ourselves. Behavioral finance calls this the overconfidence bias, and it bleeds directly into collectibles markets. Research from Fenerosh shows that 64% of investors believe they have a high level of investing knowledge, but only 25% of actively managed mutual funds, remember these are run by professionals whose entire career is to understand these markets, actually beat the market over a 10-year period. Now, the people who do this for a living, with Bloomberg terminals and research teams and decades of data, they get it wrong 3 out of 4 times. And the average collector who's been in the hobby for 2 years is confident that they know which players are undervalued. This isn't an insult. This is just human wiring. We assess our own knowledge the same way we assess our driving, against a mental model of the average person, which we almost always define as worse than ourselves. Now, what does this do to a market? It creates a bias toward action over patience. It creates the feeling that staying in cash is falling behind, because obviously we know what to do with our capital. And it creates a systematic tendency to underestimate how wrong a position can be before it becomes right. Now layer in loss aversion. Here's how I explain this one. Finding a $20 bill on the sidewalk feels good. Losing a 20 out of your wallet ruins your afternoon. The math is going to be identical, but the emotional experience is not. Loss aversion research tells us that the pain of losing something is felt roughly 2 to 2.5 times more intensely than the equivalent gain. We are not symmetric about winning and losing. Losses hit harder than gains feel good. Now, in practice, this means that a collector sitting on a card that's down 40% will do almost anything to avoid crystallizing that loss. They'll hold through multiple market cycles, waiting for the price to return to what they paid. They'll anchor to their cost basis as though it's meaningful market information. It isn't. The market doesn't know or care what you paid, and they'll use every new rationalization available to delay the decision. This is how incorrect prices persist. It's not because buyers and sellers have agreed that a card is fairly valued. It's because sellers who paid the wrong price refuse to acknowledge it, and that refusal holds the ask artificially high for far longer than a frictionless market would allow. And lastly, there's herd behavior. Now, research on financial markets shows that it only takes about 5% of informed directional participants to trigger FOMO behavior in the other 95%. 5%. Now, in a Discord server with 200 members, 10 people talking about the same card with genuine conviction will move the other 190 into considering whether they should be buying. Most of the people entering a position in the first few days of a move aren't responding to data. They're responding to the fact that other people are moving around them. That distinction matters enormously because a move built on herd behavior rather than on fundamental supply and demand will sustain itself exactly as long as the herd stays pointed in the same direction, not one day longer. Let's put all three of these together. Overconfidence keeps people in positions past where they should have exited. Loss aversion holds ask prices artificially elevated when the market turns, and herd behavior generates momentum that has no fundamental anchor. The result is a market with remarkable staying power in both directions. Prices that won't move even when they should, and prices that won't stop moving when they start. That's inertia. You can't fight it by being right. You can only understand where it comes from. Now, here's where it gets interesting. Because the psychological layer is only one part of the equation, there are structural forces in this market that create mechanical buying pressure, price support that exists completely independent of whether a card is fairly valued or not. In financial markets, there's a concept called the inelastic markets hypothesis. The data behind it is staggering. A single dollar of inflow into the stock market can increase total market capitalization by $5. That's 5 to 1. The reason is because large institutional funds are largely required to deploy capital in specific ratios. There's certain things they have to buy regardless of price. This mandated buying pushes prices far beyond what analysis would justify. The card market doesn't really do this, but it has a structural analog. It's changed dramatically in the last several years, and understanding what it's changed tells you a lot about where the current market is structurally weak. The classic version of mechanical support in the card market was the rainbow collector. A serious player collector, someone buying a complete parallel run of their guy, is a structurally forced buyer. It doesn't matter whether the price is fair. They need the gold, the silver, the red, the prism, the out of 10, the 25. The mandate is completion, not return optimization. That mandate creates price support at every tier of a player's parallel stack because those buyers will absorb supply that nobody else would touch. But something happened to that dynamic in the last 5 or 6 years, and I don't think enough people are talking about it. Modern sets have destroyed this completion incentive. 2013 Prism had 11 parallels. Today's sets have 80 plus. A 200 card checklist with 83 parallels per player isn't a set, it's a catalog. No serious collector is going to attempt to complete a rainbow of a player they love when completing that rainbow would require identifying, sourcing, and purchasing somewhere between 80 and 100 individual cards. The scope is paralyzing and the cost is prohibitive. And the emotional satisfaction of completion, which was always the psychological engine driving rainbow behavior, gets diluted when the finish line is that far away. What this means structurally is that modern sets have largely forfeited the mechanical buyer support that vintage sets benefited from. The forced buying that used to prop up prices later throughout a parallel stack simply doesn't materialize in the same way anymore either. The mandated buying is now concentrated at the top. The 1 out of 1, the out of 5, the out of 10, and the mid-tier parallels are left to find buyers on the open market without that completion floor underneath them. That's a real structural vulnerability in modern products, and it's one reason why the low end of this market, cards under $500, is currently sitting at roughly 43% of all-time highs, while high end is at 96% of all-time highs. It's not that low end is less loved, it's just that the structural bid that used to exist for them has partially collapsed. Now, when structural support is weak and psychological biases are keeping prices elevated, shouldn't sophisticated, data-driven capital step in, identify the mismatch, and arbitrage it back towards fair value? That's what happens in financial markets. But in these financial markets, that's theoretically the job of hedge funds and institutional players. But even there, hedge funds only represent 5% of total equity market volume. In the card market, the picture is even more stark. At the low and mid end of this market, cards from a few $100s, maybe under $1,000, there's almost no sophisticated arbitrage capital at all. The people trading in these price ranges are predominantly individual collectors making emotional decisions, not systematic analysts running capital against supply models. The arbitrage mechanism that should theoretically keep prices rational simply doesn't exist at meaningful size in these levels. Now, high end is different. When a messy 2014 Prism Gold changes hands for $1 million, you can be reasonably confident that both sides of the transaction have done serious due diligence. The buyers at that level are managing real capital and treating it like real capital. Price discovery at the high end is more honest than most collectors realize. But from the mid-tier down, the market is largely running on psychology and herd behavior, with almost nobody positioned to step in when prices get irrational in either direction. There's a practice among sophisticated card sellers that doesn't get discussed nearly enough, and I think most buyers have encountered it without fully understanding what they're looking at. A dealer or a power seller lists a card at a price that seems exorbitantly high. Not a little high, meaningfully above any recent comp, many times 3 to 4x. Many people scrolling past it assume they're just being greedy and they move on. But that price is actually a probe. What they're watching for isn't a direct buy, it's the offers that come in below ask. If a card is listed at $800 and 3 people make offers between $500 and $600 in the first 48 hours, the seller now knows something the market hasn't priced yet. There are at least 3 live buyers in the $500 to $600 range, meaning the real clearing price is probably $550 to $650. They can now either counter, relist at a more targeted number, or hold, knowing exactly what the depth of demand looks like. The high ask wasn't really a price, it was a demand survey. The second version of this is something I find genuinely clever, and it happens in real time around auctions. Let's say a card has a buy it now listed at $300. A 7-day auction for the same card ends and clears at $340. In the window between when that auction result becomes public and before the buy it now seller reprices, sometimes minutes, sometimes an hour, the buy it now at $300 is now provably underpriced. There are people who watch specific cards close enough to have buy it now searches queued up specifically for this scenario. The moment an auction breaks through a live buy it now, it becomes a race. Whoever identifies the underpriced buy it now first wins. That's not a flaw in the market. That's the market doing exactly what markets are supposed to do, allocating to the most attentive and fast-moving participant. But it's worth understanding as a seller because failing to monitor your own buy it now prices relative to live auction action is leaving money on the table in a way that's entirely preventable. What both of these mechanics illustrate is the same underlying principle. Information is not evenly distributed in the market. The people who are most embedded in it, who are watching the most cards, processing the most price signals, running the most systematic observations, these have a structural advantage over people who check prices periodically and react only to what they see. The antidote isn't to become a professional market watcher. It's to understand that the price you see at any given moment is a function of information asymmetry as much as it is of supply and demand, and to factor that in when making buying and selling decisions. This is the practical center of everything I've been building towards. Because understanding inertia conceptually is useful, understanding what breaks it is actionable. Let's start with what breaks inertia to the upside, what turns a dead market into a moving one. The clearest example I've seen recently happened in the soccer card market in Q3 and Q4 of 2025. The market had been slowly building for months. The soccer index was up about 30% year to date, and high-end Messi and Ronaldo cards were doing their thing. But mid-tier and rookie categories had been choppy and illiquid. A few Discord servers started mentioning specific cards. But the interesting thing was they'd moved on from Messi, and they moved into kabooms. First-year kabooms especially for players who'd been on the radar, but maybe hadn't had their moment quite yet. And here's the thing about the soccer market that makes this dynamic so pronounced. The daily transaction volume for the entire soccer card index averages around $61,000. That's it. $61,000. The entire soccer market measured by daily average volume is roughly what a mid-tier basketball card can do in an auction. When a market is that thin, it only takes 5 or 6 committed buyers to move a category. Not 500, not 50, 5 or 6 people coordinating, just by talking about the same cards in the same server on the same day. They can then absorb the available supply, spike the visible comps, and create the appearance of a trending market. That appearance then triggers the herd, which triggers actual demand. Now, this isn't manipulation in the traditional sense per se. It's just what illiquid markets do. The 5 to 6 buyers weren't wrong about the cards being undervalued, but the mechanism of price discovery in a thin market looks almost indistinguishable from manufactured momentum, because in a thin market, genuine conviction and manufactured momentum are hard to tell apart until you're far enough through the move to see whether the demand really had some legs. The broader signal to watch: when Discord servers, group chats, Facebook messaging portals who operate independently of each other start converging on the same cards, then that convergence is inertia breaking, not after, at the convergence points. By the time you start reading about a newsletter or see a screenshot posted in 6 different places, the move has already started happening. Now let's talk about what breaks inertia to the downside, because this side of the equation gets less attention and costs people more money. Price corrections in card markets almost never announce themselves. They don't come with a clear macro trigger or an obvious catalyst reversal. What actually happens is quieter and more insidious. First, the most sophisticated holders start thinning positions. Not selling everything, just reducing size, listing a few cards they've been meaning to sell. The average collector doesn't notice because volume stays roughly consistent, prices don't visibly crack. Then auction velocity starts slowing. Cards that would have had 8 to 12 bidders in the previous cycle now have 3, maybe 4. The final clearing prices might still be somewhat strong, but the gap between opening bid and final sale starts compressing. Fewer people are fighting for the same card. Then the first high-profile disappointing result happens. An important card goes through auction and clears below expectation. This gets screenshotted, posted, discussed. People start getting worried. The sellers who were planning to hold now have an anchor going in the wrong direction. The buyers who are on the fence now have evidence for hesitation. And that's the moment the psychological picture flips. Loss aversion, which was sustaining ask prices during the bull run, now becomes the accelerant of the decline. The sellers who wouldn't take fair value during the run up now won't accept anything below their peak comp, even as the peak comp recedes further with every passing week. They hold, the bids drop, the gap between bid and ask widens, liquidity evaporates, cards sit on the market, and the market goes quiet. Quiet is not the same as stable. See, in a card market, quiet usually means the transition between what people were willing to pay and what they're now willing to pay hasn't been fully acknowledged yet. It's the eye of the storm between the run and the repricing. If you want one early warning indicator for when inertia is about to break downward, watch the ratio of buy it now listings to auction activity. When sophisticated holders want to sell at a known price and are willing to wait for it, they only do buy it now. When they want certainty of exit and are less concerned about maximizing the sale price, they auction it. So when you look at the active auctions versus the buy it now, if you see a lot of auctions going, you might have a run down. That's worth paying attention to. I want to close with the question that matters most right now on a macro basis. Not which cards are moving today, but where the center of gravity in the hobby is shifting over the next several years. Because inertia cuts both ways, and the market's long-term inertia is moving in a direction that most short-term participants aren't fully pricing. The most important thing I can tell you about demand in this hobby is that it has fundamentally bifurcated since 2022. And this bifurcation, this moving in 2 different directions, is structural, not cyclical. The high end of this market, cards above $5,000, is currently sitting near or over all-time highs. The low end, everything under 500, is far off these all-time highs. These are not 2 parts of the same market experiencing the same cycle at different speeds. These are 2 different markets operating by different rules with different participants. The high-end market behaves like wine or art. The people buying at that level are treating these as alternative assets. They're comparing them to other stores of value, not to other card purchases. The thesis driving their capital is scarcity plus legacy plus liquidity, and the cards that have all 3 are being bid towards prices that look absurd to a collector who came up buying $50 rookies. But they're not absurd inside the framework that buyer is operating in. The low-end market behaves more like streetwear or sneakers. It's driven by trend cycles, by community consensus, by whatever's getting attention at that moment. The problem is that the product supply in modern releases is not structured to support the kind of scarcity that makes a $50 card worth $200 3 years later. When gem rates are above 60% and there's so many parallels floating around, that $50 card is not an alternative asset. Now, the collectors who are going to do best in this market over the next 3 to 5 years are the ones who understand that these 2 markets require completely different strategies. Different cards, different hold periods, different exit frameworks, different expectations for what working looks like. The deeper shift I'm watching on the demand side is generational. The millennial collector, now in their 30s and early 40s, at or near peak earning power, is buying nostalgia, not just emotionally, systematically. Pokemon is at 2 times its all-time high. Star Wars cards are up 169% year to date. These are not coincidences. These are the fingerprints of a generation with disposable income reaching back to things that mattered to them at 14, at 15, and treating them as real assets for the first time. My question for you to think about is what comes next? The generation behind millennials, older Gen Z, the 22 to 28-year-old cohort, they grew up on different reference points. Their cultural touchstones aren't baseball cards and Pokemon base set, they're anime, they're specific gaming franchises, they're players who broke through in 2019 or 2022, not 2003. The hobby center of gravity is going to follow that demographic as it gains earning power. Maybe not immediately, but the cards that have the most long-term demand durability are the ones that sit at the intersection of genuine scarcity, real population constraints, and they're not manufactured parallel scarcity. Cultural permanence for both current buyers and the buyers who are still 5 to 10 years from having serious capital is a fundamental thing to watch. Legacy, as we define here, isn't just about what a player has accomplished. It's about whether their story enters and re-enters public consciousness over time. Michael Jordan retired 20 plus years ago. He still beats out Kevin Durant in weekly Google searches. That's not nostalgia, that's something more durable. It's the kind of narrative that refreshes itself for new audiences without losing the original audience. Cards with the most structural appeal going forward are the ones attached to that kind of legacy. The first meaningful sets. The low population PSA 10s with gem rates that tell an honest scarcity story. The cards that sit at the intersection of a player everyone has heard of and a supply structure that rewards the people who found them early. The inertia in this market is real, but it's not permanent. And it breaks in one direction when enough informed conviction and thin liquidity converge on the same names at the same time, but it breaks in the other direction when sophisticated holders quietly start exiting into bid depth that might not be there next month. Your job is to understand which phase you're in and to have done the supply work before the move starts, not after already in the screenshot. That's The Edge. Thank you for listening to Slabnomics. Keep building, and I will talk to you later.